Today we're going to look at the weighted average cost of capital. We're going to understand what it means. It is called WACC. We're going to understand what WACC means, how it is calculated, what the interpretation of the result is, and how various people in the industry, in the finance industry, use the weighted average cost of capital. So you're welcome to this class. If you're just joining us for the first time, I urge you to subscribe to the Finance Simplifier. My name is Echela Okwori. So, straight away, what is WACC? WACC is the average interest that a company, the interest rate that a company pays to finance its assets. So, we've explained before that the capital structure of a company is the mix, the combination of the debt capital and the equity capital. Now, we know that financing projects cost money, and there is no free lunch, not even in Freetown. So every way, every source, whether it is debt, whether it is equity, any source of capital that a company decides to use to finance its project costs money. So that is the average cost. When you combine the costs of the equity and the cost of the debt that is used, that is what we refer to as the weighted average cost of capital. Now, we've explained that there are capital sources which could be debt and which could be equity. Now, this weighted average cost of capital is also the minimum return that a company must earn to satisfy its investors. So it is also the hurdle rate. It is also the hurdle rate, and it helps to create value. If project returns are lower than the WACC, then the company loses value. So investors expect that their returns will be higher than the weighted average cost of capital. So once the returns that an investor is getting is lower than the WACC, then that investment is not a good one. Okay, next we're going to look at the core components, of the WACC. The cost of debt is very important to calculate the WACC. So that is the effective interest rate paid on loans and bonds. So if you're going to borrow funds, whether it is from issuing of bonds or you're going to take a loan, it has an effective interest rate. It is not something that is hidden. It has an effective interest rate, and it's usually cheaper compared to equity. Equity is a contribution of the shareholders. It's a contribution of the shareholders. So that is equity. Shareholders' capital is equity. And debt capital is usually said to be cheaper. That's why some rich folks love to use borrowing more than their own money. You say the man is very rich. Why does he need to borrow? Because he understands the secret of finance. Because he knows that debt capital is cheaper. But how is it cheaper, if I may ask? It is cheaper because interests are tax deductible. You are allowed to deduct the interest that you pay on the borrowing from the amount of money from your earnings for the purpose of calculating your tax liability, which is not the same for equity. So we say debt capital is actually cheaper. It's usually cheaper due to tax deductible interest payment. But it is a high risk. It's a very, very high risk to take borrowing because, when there's liquidation, they rank first before the ordinary shareholders. Also, there's a cost of equity, which is also another very important part for us to calculate. Yes, the cost of equity. Now, the cost of equity is a return that shareholders expect for risking their capital. So if you're going to buy shares, it means there's the opportunity cost of that money that you're using to buy shares. You could have used it for something else. So for that sacrifice that you're taking, you expect a minimum rate of return. So that is also one of the fundamentals in the core components. Another one is it's trickier to calculate and generally more expensive than debt. Yes, calculating the cost of equity is not as simple as calculating the cost of debt. You know that the cost of debt is the effective interest rate. If you took a loan, you know how much the interest rate is. So it's not something that you work so hard to get. It is known. But for interest, to get the cost of equity is not so straightforward. That's why we say it is trickier to calculate. And why is that so? We use what we call the capital asset pricing model. We have done that. So if you've not watched that video, I urge you to just scroll down on my videos and search for CAPM. That is CAPM, Capital Asset Pricing Model. That is the CAPM. CAPM, that is what is used. So we use that. We use CAPM. So that is usually how we get the cost of equity. So there's also weight. The weight we have, the debt has weight, and the equity also has its own weight. So the exact percentage mix of debt and equity is what we use to get the weighted average cost of capital. Good. Now let's look at the formula for it. So we'll say weighted average cost of capital is equal to, we'll say this is equity, E all over V. Equity, that is E for equity, divided by V, I will explain what all of them mean, multiplied by the cost of equity. So we do this on one side, and then we say plus, we also do the same for, here we say debt all over the valuation multiplied by the cost of debt. But because the cost of debt, because interest is tax deductible, we will now multiply by 1 minus the tax rate. So this is the formula for the weighted average cost of capital. Now let's explain what they all mean. Now, to do this, we're going to use an example, but let me just explain the formula. So this E, the E is the equity that the company has. So if you look at the total capital that the company has, the part of it in value that is equity, that is shareholders' contribution, that is the E. Now, when you add the part that is equity plus the part that is borrowing, that is debt, when you add them together, you get what we call V. So now this RE is the cost of equity. As we said, people who sacrifice their money and give to the company in form of buying shares, they are sacrificing and they expect to get some returns. So this is their expectation. This is the cost of the equity. It means it is what they require. It is the minimum rate of return that they expect to get for what they have sacrificed. So this is the cost of equity. And I said we use CAPM. We use CAPM, Capital Asset Pricing Model, to calculate this. It's very easy to explain and understand. And I've done a video on it. I urge you to go and watch the video. Finance Simplifier is there for you to watch. Now this D, what is D? D is the part of the total capital that is debt. So this is for D. And of course, I've explained what V is already. Now this RD, RD is the cost of debt. So if you are taking a loan, if you are issuing a bond, that is borrowing money from people who buy your bonds. Basically, if you take a loan, however you do it, using any of the sources of loans, and it is not equity capital, so it comes at a cost, and there's usually the effective interest rate. So that is your RD. Now this one here, one is a constant, And then this T is the tax rate. This is tax rate. Tax rate. It could be 20%, it could be 30%, it could be 40%. So we'll move ahead. Now let's illustrate the weighted average cost of capital with an example. Yes, let's do it. Let's solve this question, and then it will be very clear to us how to calculate the weighted average cost of capital. Now this question says HLR PLC is worth 100,000 total. This is really small. I should be worth more than this. Well, it's just an illustration. So we say HLR PLC is worth 100,000 naira total. That's the total capital of HLR PLC. Now it has 60,000 naira in equity. You see, this is equity. This is equity. It has 60,000 in equity. That is 60% of the total with a cost of 10%. And it has 40,000 in debt. That is 40% of the total with an interest rate of 5%. The tax rate is 25%. Okay, so what is the WACC? So coming down here, what do? We simply say, E. What is our E? E is the equity. Equity is 60,000. Okay. Divided by V. V is 60 plus 40, which is 100,000. So we say over 100. Okay. Multiplied by the cost of equity. The cost of equity is 10%, which is 0.1. So, you see this? Then we'll say plus, we'll come here. This is, what is our debt? Debt is 40,000. 40,000 divided by V, which is still 100. Multiplied by the cost of debt, which is 5%, which is 0.05. And then multiplied by 1 minus, what is the tax rate? 0.25. So, you see that? Now, if we come down here, this 60,000 divided by 10, so this will cancel all of this. So 10 into 6 is 0. 10 into 60 is 6. So this is, the whole of this is 0.6 multiplied by 0.1 times 0.1. We'll close this. We'll say plus. Here, what do we have? The whole of this will cancel the whole of this. This will give us 10 into 4 is 0. 10 into 40 is 4. 0.4 multiplied by 0.05. And then also multiplied by 1 minus 0.25 will give us 0.75. Good. So let's work this out. Let's work it out. So that will give us 0.075, which is, if you multiply it by 100, you multiply it by 100. So we say this multiplied by 100. So that will give us 7.5. So our answer is 7.5. So this is equal to 7.5%. This is our answer. So this is our WACC. Now, having demonstrated this, this is the easy part. Calculating it is the easy part. Now, what does it mean? The WACC is simple. It's telling us that this is the cost of the capital of the company. That is the total sources of capital of the company. The company has some debt capital and has some equity capital. But the cost of getting it is 7.5%. So what it means is that people, investors, will expect to get nothing less than this as their returns. That's what it means. Now, let's look at how different people use the weighted average cost of capital from this interpretation that I'm given. Let's look at corporate executives and CFOs. So we'll look at this. How do executives and CFOs use WACC? First, they use it for project approval. So if they have they want to know whether a project is worth approving or not, they use the WACC as a benchmark. And how do they do it? So if it's a new factory, if the factory offers a return of 10% and the WACC is 7.5, it means it is higher than the WACC that we've calculated. So it is a good one. So they accept the project. But if it is lower, they reject it. So they use that. Another way corporate executives use WACC, they use it in budgeting. It helps them to decide whether to fund growth through new loans or by issuing stock. So they look at this. Sometimes we are thinking, should we raise our capital from outsiders? I mean, from selling shares, or should we just borrow by issuing bonds? So they use the weighted average cost of capital to also do this. As I said before, it is cheaper sometimes to use debt capital because it is, of course, the interest is tax deductible. So they look at this when they calculate their WACC. If the WACC is very high, then they know that it might not be a good thing for them because investors will still need higher than that. So they may just decide to issue a bond. Good. Now let's look at other people, how they use the WACC. Stock investors and Wall Street analysts. Basically, how do they, experts, brokers, stock exchange experts, people who participate in the stock exchange, how do they use their knowledge of WACC? The first thing is company valuation. They use WACC to value a company. If they want to acquire a company, for instance, they use WACC to value it because you know that there's something we call the time value of money, which shows that because of time, because of uncertainty, because of risk, because of inflation, money that you have today is worth more than that same money tomorrow. So to do that, usually when they have estimated cash flows, they need to discount it to present value. And to do this, we usually use a discount rate. You know that formula where we say 1 all over 1 plus R raised to power n. So this R is what we're talking about. How do you get this R? They use the weighted average cost of capital. You use WACC for it. So it discounts future corporate cash flows back to today's value to see if a stock is underpriced or overpriced. So this is how they use WACC. Then they also use it for risk assessment. When a company, if you are looking at two companies and one has a higher WACC, it means that company is riskier. It's riskier than the other one. It has more risk. And what this means is because the investors will expect a higher return because it has a higher WACC. And they always expect that what they expect must always be higher than the WACC. They can't expect lower than the WACC. In fact, your shareholders, if they discover that their return is lower than the WACC, they will sell off their shares because it means they'll be running at a loss. So they'll look for a more profitable investment. So investors, stock investors, analysts, they use the WACC to assess risk. So that's one way. The high WACC usually signals a riskier company. Okay, so let's look at another one. Small business owners. How do small business owners use it? They use it, it helps entrepreneurs to understand their true cost of doing business. Because if you are doing business, you need to know the cost of your capital. How do you get money to do your business? You get it either from debt capital or from equity. So by accurately calculating your WACC, it helps you to know the cost of doing business. Another one is in pricing. It helps them to set prices of their products, because whatever they do, they should be able to take care of the costs of production. I mean, if they look at their revenue, to get their revenue, is the revenue less your cost of production that gives you a profit. So where there's no profit and there's no loss, we say is the break-even point. So, but people I know in business, to break even, they need to have a price that gives them profit, because that is how they are able to keep their shareholders happy. That is how they are able to maximize shareholders' wealth. So to do that, they need a good price. And a good price is calculated correctly using the WACC, because when you know your WACC, whatever price you are setting, it should be such that it will give you returns that are high enough to compensate people who gave you the capital. So it ensures products' profit margins are high enough to cover both operational costs and the cost of capital. So what is our conclusion and takeaway? I will say that the WACC is the ultimate financial reality check. It tells you what capital costs, so you can make smarter decisions about how to invest it. I am Echela Okori. I urge you to subscribe to the Finance Simplifier. This is where we demystify all difficult topics. We don't just learn like we're in the classroom. We learn, we get results, we learn how to calculate, and most importantly, we interpret the results of our calculation and we compare it to real life situation. Thank you, and don't forget to subscribe. Bye for now.